This is your bank statement. It's 2000 BC. You just borrowed 60 measures of grain from the temple in Babylon. A priest pressed those terms into this clay tablet with a reed. The interest rate, 20% per year. Collateral, your field. If you don't repay, the priest doesn't call a debt collector. He takes the field. And here's the thing that should stop you in your tracks. Every single financial concept in that sentence, loan, interest rate, collateral, repayment terms, consequences for default, exists in your mortgage document today. Word for word, concept for concept, 4,000 years. And the architecture of banking has not changed. This video is not a history lesson. It is an explanation of how something as chaotic and complex as modern banking was invented without computers, without electricity, without any technology more advanced than a sharp stick and wet clay, by people who were working out the same problems you are dealing with right now. By the end of this, your bank will look completely different to you, and you will never look at your phone's banking app the same way again. The city-state of is one of the most sophisticated urban centers on Earth. Grand temples, complex trade networks, a merchant class that needs to move grain, silver, textiles, and livestock across hundreds of miles of river valley. One problem: there are no banks. So the merchants do what any rational society does when it needs a trusted, secure, neutral institution. They go to the one building in the city that nobody dares rob, the temple. Sumerian temples became the first financial institutions on Earth. Farmers deposited their grain surplus. Merchants deposited their silver. The priests kept meticulous records, pressed into clay tablets in a script called cuneiform. Every deposit noted, every withdrawal noted, every loan issued with terms. And the loans were sophisticated. Seed grain issued to a farmer before planting, with repayment due from the harvest at 20% interest. Silver lent to a merchant for a trade voyage, with the interest rate rising if the ship was lost at sea, what we now call risk-based pricing. The priests even used cylinder seals, small carved stone rollers that, when pressed into clay, left a unique impression, like a signature, like a pin. No two seals were alike. You couldn't forge one without being caught. The Babylonian King Hammurabi understood that a functioning economy needed consistent rules. Around 1754 BC, he codified the world's first financial regulations into what we now call the Code of Hammurabi, 282 laws carved into a 7-foot stone pillar. 16 of those laws deal specifically with banking, maximum interest rates, rules for loan contracts, what happens when a borrower can't repay, penalties for a banker who falsifies records. Your country's banking regulator did not invent banking law. Hammurabi did. In 1754 BC, fast forward to ancient Greece, 5th century BC, the invention of coinage has changed everything. Before coins, you lent grain and got grain back with interest, manageable. Now merchants are moving silver coins across the Mediterranean, funding trade voyages to Egypt, Persia, the Black Sea coast. The sums are enormous, the distances are vast, and the risks of lending to a stranger you've never met are very, very real. So the Greeks did something clever. They invented the Trapezitai. The word comes from trapezas, meaning table, because the bankers literally sat at wooden tables in the agora, the public marketplace, and conducted business in full public view. Why in public? Because reputation was the only security system they had. In ancient Athens, a banker's credibility was his entire business model. You lent to people whose reputation you could verify through community knowledge. This is a credit score. Built and run entirely by social memory, the Trapezitai offered deposits, loans, and currency exchange. They tested coins for authenticity, biting them, weighing them, listening to the sound they made when struck. Counterfeit coins were a massive problem. A skilled trapezites could identify a debased coin in seconds by feel and sound alone. The interest rates were calibrated to risk in a way that would be recognizable to any modern banker. Standard loans, around 12% per year. Maritime loans, funding a merchant ship on a voyage with all the attendant risks of storms, pirates, and foreign ports, could carry rates of 22 to 30% per voyage. Higher risk, higher rate. The concept is called a risk premium. It is still the foundation of every loan pricing model used by every bank on Earth today. Here is the part that drops jaws. Greek bankers issued letters of credit for traveling merchants. You deposited money with the Trapezites in Athens, received a written document, and could present that document to a partner banker in Corinth or Ephesus to withdraw funds. You did not carry gold across Greece. You carried a piece of papyrus. This is a bank transfer, performed in 400 BC, without a computer, a wire, or a Swift code. Just trust, paper, and a network of bankers who knew each other. Rome. 2nd century BC, the most sophisticated economy the ancient world had yet produced. Roman banking was so advanced, it had a specialist for every function. The Argentarii handled deposits, loans, and currency exchange. The Numularii tested coins and detected counterfeits. The Mensarii were state-appointed public bankers deployed in financial crises, essentially the Roman equivalent of a central bank emergency intervention. They operated from tabernae, small shops in and around the Forum Romanum, the commercial heart of the empire, and they kept meticulous written records called tabulae, which were legally admissible as evidence in court. A Roman banker's ledger was a legal document. But here is the Roman innovation that most people have never heard of, and that will make you look at modern finance completely differently: bankruptcy. In Rome, if a banker failed, if he could not repay his depositors, the event was called forocedere, literally, fleeing the forum. Here is why that phrase exists. The presence of a banker in the forum was his proof of solvency. While he sat at his taberna table in the forum, visible to everyone, he was signaling, "I am here. My business is solid. I am not hiding." The moment he stopped showing up, the moment he fled the forum, every merchant in Rome understood that he was insolvent. It was a public declaration of bankruptcy, not through a court filing, through absence. The Roman word for a failed banker was someone who'd stopped showing up to work. Today we call it Chapter 11. 4,000 years of financial history, and the concept hasn't moved. Roman banking became so sophisticated that bankers formed associations, societates, Argentarii, where members contributed capital jointly and held unlimited personal liability to prevent fraud. If your banking partner defrauded a client, you were personally responsible for the loss. Unlimited personal liability. Every partner on the hook for every action. No limited liability corporations, no bailouts, no too big to fail. When the Roman currency was repeatedly debased by emperors in the 3rd century AD, when the silver content of the denarius dropped from 85% to less than 5%, the Argentarii simply vanished from the historical record. Most of the banks failed. Without sound money, the banking system collapsed. The debasement of currency destroyed Roman banking. Write that down. 1119 AD, Jerusalem has just been captured in the First Crusade. Christian pilgrims are flooding toward the Holy Land from across Europe. The journey takes months. The roads are controlled by bandits. Carrying gold and silver the entire way is not just uncomfortable, it is a death sentence. A French knight named Hugues de Payens proposes a solution. His order, the Knights Templar, will protect the pilgrims, and they will solve the money problem. Here's how it worked. You are a merchant in London in 1150. You need funds in Jerusalem. You go to the nearest Templar preceptory, their local headquarters, and deposit your silver. In return, you receive a letter, encrypted, coded in a cipher using symbols derived from a Maltese cross that only the Templars knew how to read. You travel to Jerusalem. You arrive at the Templar preceptory there. You present your letter. The Templars decode it, verify the amount, and hand you equivalent funds, minus a handling fee. The Knights Templar invented the ATM network. Deposit in London, withdraw in Jerusalem, no cash carried, fee charged. The Templars even did foreign exchange, converting your English silver into the local currency at your destination. By the 13th century, the Templars owned a fleet of ships, the entire island of Cyprus, and a financial network spanning from England to the Holy Land. They were lending money to kings. They were financing wars. They were, in every practical sense, the most powerful bank in medieval Europe. Then in 1307, the King of France, who owed the Templars enormous sums he could not repay, had every Templar in France arrested in a single coordinated dawn raid. The charges: heresy, blasphemy, and various invented crimes. The real reason: debt and greed. The Templars were tortured, stripped of their assets, and their order was dissolved. The king canceled his debt, by erasing his creditors. This is the oldest trick in sovereign debt management, and it was last used by, well, we've covered that in other videos. Florence. 1397. Giovanni de' Medici opens a bank. By this point, the Catholic Church has a problem with banking. The Bible prohibits charging interest. Usury is a sin. But European commerce is expanding at a pace that requires credit. Somebody has to finance it, and the Medici are going to figure out how. Their first innovation, double-entry bookkeeping. Before the Medici, banks kept single records. A loan was written down once. If someone altered the entry, or the document was lost, there was no cross-reference. The Medici introduced a system where every transaction was recorded twice, once as a debit, once as a credit. The two sides always had to balance. Any discrepancy revealed an error or a fraud. Every business on earth uses double-entry bookkeeping today. Every accounting software, every corporate audit, every tax return. The Medici did not invent accounting, but they built the system that made modern financial accountability possible. Their second innovation, the letter of credit as a way to disguise interest. Since charging interest directly was a sin, the Medici charged it indirectly. A merchant depositing gold florins in Florence received a letter of credit redeemable in London, but at a slightly unfavorable exchange rate. The difference between the deposit rate and the withdrawal rate was the interest. The church got the theology it wanted. The Medici got paid. This is the first known deliberate regulatory arbitrage in financial history, finding a legal way to do something the regulator has technically prohibited. The practice is alive and well on every trading floor in the world right now. The Medici disguised interest as a currency exchange fee to satisfy church law. Modern banks call it an arrangement fee or processing charge. The financial regulators call it creative. The Medici also created the first holding company structure, a central bank in Florence with semi-independent branch banks in London, Geneva, Rome, and Bruges, each operating as a separate legal partnership but ultimately controlled by the Medici family. The world's first multinational bank, 1497, it collapsed eventually, not because the model was wrong, but because the later Medici made loans to kings who never repaid them. The same mistake that would later doom the Templars and that would resurface in the 2008 sovereign debt crisis. Financial history does not repeat itself exactly, but the same mistakes appear on a reliable rotation. Here's the thing that strikes me most after going through 4,000 years of banking history. The ancient Sumerians had deposits, loans, and interest rates. The Greeks had bank transfers and risk-adjusted pricing. The Romans had ledgers, audits, and bankruptcy law. The Templars had encrypted international transfers and network banking. The Medici had holding companies, double-entry bookkeeping, and regulatory arbitrage. None of them had electricity. None of them had computers. None of them had the internet. What they had were the same human problems we have today. How do you move wealth safely across distance? How do you verify that someone is who they say they are? How do you lend money without being defrauded? How do you keep records that cannot be altered? Your banking apps solved those problems with cryptography and servers. The Sumerians solved them with clay and fire. The Templars solved them with ciphers and stone fortresses. The solutions changed entirely. The problems never did. Which means, and I want you to really sit with this, the next time someone tells you that decentralized finance or blockchain or digital currency is going to fundamentally change banking, ask them which of the 4,000-year-old problems they're actually solving. Because the money system that exists today was not built by regulators or governments. It was built by priests, grain merchants, warrior monks, and Florentine families, all trying to solve the same problem, one clay tablet at a time. Tell me in the comments, which of these ancient innovations surprise you most? Because I have a feeling the Templars' encrypted ATM network is going to win, but I've been wrong before. One thing before the end card. Every banking system you just watched was built by people who figured out how to generate income from understanding how money moves. Before there were jobs, before there were corporations, before there was a boss to answer to. The Templar took a fee for every transfer. The Greek Trapezites earned a spread on every currency exchange. The Medici charged a margin disguised as a rate difference. None of them were employees. All of them built systems that paid them while they slept. The modern version of that is affiliate marketing. Building content that earns commissions from products you recommend without carrying inventory, without managing customers, without needing a team. I learned how to do this through Wealthy Affiliate. It's a platform that teaches you step-by-step how to build an online business around content and commissions, the same model that runs this channel, no experience required, free to start. The link is in the description. If the idea of building income that compounds while you're doing other things, the same idea those ancient bankers built entire empires on, sounds worth exploring, go take a look.